Look at Japan. Japan from 1990 until today, if you put your money in, and I think it was like January of 1990, you would still be lower 30 years later. You'd still be lower than that date in 1990. Okay. We're getting closer, but we're still not close. It actually went down for, I think, 22 years in a row, something like that. It's only started to come back up in the last few years. So my point is we can't know the future. So we don't know what's going to happen next year or 10 years from now. We don't know. But I can tell you that from my experience, looking at our country and other countries, there's no reason why we couldn't experience what Japan reached. It's certainly possible. And so if you have a buy and hold mentality and you just assume things are going to go up all the time because they always have, I think you're putting yourself in a precarious position.
Hey, it's Rocky. Welcome to Richer Soul. Today's guest is Kirk Chisholm, and we're going to chat about how to manage and build wealth. Imagine it's 12 months from now, and you've achieved your major life goals. How does it feel to be in the best shape of your life, to wake up energized, excited about the day, to have great relationships and friends who support you and propel you forward? How does it feel to have an excess of money, to be able to make the choices you want, to be fearless and open to trying new adventures? Imagine being connected to the universe and it providing everything you desire. It's possible over time, and your past does not dictate your future. The only thing holding you back from this vision is you. It's time to take control of our thoughts and use them to our advantage. Welcome to Richer Soul, where we achieve our dreams and create harmony to health, wealth, relationships, time, and spirituality. If you have not had a chance to listen to episodes 1 through 9, I encourage you to go back and listen to the framework behind Richer Soul and how to create the life of your dreams. You can also find all the show notes for this episode at richersoul.com. Today's quote is from an unknown source. The truth will set you free, but first, it will piss you off. We're going to talk about half-truths in investing and building wealth today. And before we do, I want to talk about some truths in life. First, we need to address last week's action step, which is to not eat because it's mealtime, but to eat because you are hungry. There's truth in that. To stick to real foods and to take your time. There's truth in what real food is and what's fake. And if I look at a grocery store, more than 80% is fake. The signaling systems are not working very quickly in our body. It takes a while for us to realize we're full, and that's why we get in trouble, and sometimes we overeat. The reality is, food is fuel, and if you fill your body with garbage, the long-term outcomes are horrible. Sure, sugar makes you feel great in the moment. I love that dessert, but that's about it. Back to life and truth. I find it ironic that in life, we don't even get to pick our own names. Someone else picked our name. We didn't get to pick our hair color, our eye color, or how tall we'd be. I know some people spend a lot of money trying to change their body through various medical treatments, thinking it will solve their problems. The truth is, it won't. The key is to realize that we were given what is perfect for us in our purpose, and to find out what that is and to live in harmony with that. Maybe we should choose a new name in life. I wonder how many people would go with something that's vanity-driven in that case. The reality is you can choose to be whoever you want to if you have the ability and the willingness to do the work for it as well. When it's in alignment with who you are, it's so much easier. For example, I don't ever plan on trying out for the NBA because I know I'm not tall enough. But that's okay. That wasn't my purpose. And so I let go of it and I don't worry about it. Today, we're going to talk about truths in building wealth. We'll take a moment to share historical perspectives and what's happened in the past and how that applies to today. They call this personal finance for a reason. It's personal. But most people don't ask personal questions. They tend to ask generic ones, or what are you doing? They don't understand themselves, nor do they understand their goals. Without that knowledge, they have a plan that's not going to work for them. It works for somebody else. And then they give up. One of the biggest lessons I've learned is to know myself and how I will behave during certain market conditions. How do I create the wealth plan that serves me and lets me sleep at night? How can I create a plan that doesn't take too much work on my part? It takes a lot to put this all together. But now I have, and now I just let it run. And so it takes so much off of my plate. I can go enjoy life. Today's guest is Kirk Chisholm. He is a principal and wealth manager at Innovate Advisory Group, an independent RIA located in Lexington, Mass. He's been providing financial advice to individuals and families since 1999. Kirk's influence and innovation has promoted change in many areas of the wealth management industry. He provides a different perspective on many commonly held beliefs when it comes to portfolio management, retirement investing, financial planning, inflation, economics, and other personal finance topics. He also has rare expertise with alternative investments, helped in self-directed IRAs, and has helped many investors invest in their passion. He is acknowledged as the number 7 most influential financial advisor on Investopedia's Top 100. He's also listed as one of the top 10 social media all-stars in the financial services industry. And he's host of the Money Tree Investing Podcast. Let's meet our guest. Welcome to Rich Your Soul, Kirk Chisholm. It's great to have you join us today.
Yeah, thanks for having me on, Rocky.
I'm excited to learn from you today. We always like to start at the beginning. What was it like when you were growing up, and how much did your family and school teach you about money?
Yeah, it's an interesting question because I think back when I was growing up, money was not something that was talked about. I mean, I grew up in the Northeast, so everybody up here were kind of old Yankees. Nobody talks about money, right? It's like sex, politics, and money are the 3 things you don't talk about. So no one really talked about money. My dad was a Scot and very thrifty. So I think a lot of that kind of mentality was baked into a lot of our conversations about thrift. I mean, he grew up in the Great Depression where people had nothing. So there was that overlay as well of you got to save for a rainy day because you never know when it's going to rain. Of course, it hasn't really rained since the Great Depression in the way that he was accustomed to. But I think it's a good framework to understand people and how they think about it. So I think really, when you're talking about money, there's a lot of different money scripts that people have. And, mine was certainly thrift. And, I think it's valuable when you take it with a grain of salt, but, you take it a little too far. And of course, it can be a detriment as well.
And it sounds like school didn't teach you anything?
No, it was never a conversation in school. I think in high school, we had an option to take an economics course for half a semester, assuming you could get into it. But it was kind of like one of those senior joke classes that they do take right before, senior spring. But no one in school teaches about money. I think it's one of the problems in our culture is nobody talks about it. No one teaches it. So you have a bunch of people in society who have no idea how to manage money, of their own money. And I think that's a real problem.
And we find that to be the case all the time. So how did you get from there into wealth management?
Yeah. So, it's interesting because when I was in college, this was kind of the heyday of the tech boom. and any idiot could make money. I remember those commercials in E-Trade where the babies were making money, and I mean, it was just ridiculous back then, where you could throw darts at a board. I remember, a lot of the media was like, all right, we're going to have the birds poop on the paper. We're going to put the financial section under the birds, and wherever they poop, that's what we're going to buy. Or throwing darts at a board with the, with a list of stocks. I mean, that was what was going on. It's like, can you beat a monkey at stocks? And, it's fun and entertaining. And it was interesting to me at the time because it seemed like you have this aspect, this economy where a lot of really smart people, like the Warren Buffetts of the world, were underperforming the market because, he was espousing things like value investing. And of course you had, the CNBCs of the world who were talking about, you buy this crazy stock with no earnings that's probably going to be bankrupt in a year because it's going up. And to me, I've just found it fascinating because you have so many different points of view, and, who knows who's right? It's like a big puzzle. Like, how do you determine what the right approach is to investing? So I found it to be one of those challenges that you can't really solve, but it's fun in trying to solve it. So I really got into it, and that really kind of started my career. And just for reference, that was great in college, but literally my first month in this business was December of 99. So I basically started my career at the peak of the tech bubble, and the next 3 years, the market pretty much went down. And I think I make that point because at the time it seemed like, woe's me, why does this happen to me? I just started at the worst possible time in the industry. But, I trogged through it. And what I learned was a really valuable lesson, which is, a lot of people gave up because it was hard. And the lesson I learned from it was the value of risk management. Because, the markets went down for a few years in a row. And I don't think people realize that, because now the markets go down 30%, 40%, and they pop back up, which to me is kind of crazy. But the fact it went down for a few years in a row, you learn really quickly why it's important to not lose money. And most people in the industry are just saying, oh, good, it's lower, we can buy at cheaper prices. But then it kept going lower. And so one of really the underpinning of my whole philosophy of investing in our wealth management philosophy is risk management first. And that has done wonders for us. And it's allowed us to take advantage of the upside when it's going up, and, not losing big when it goes down. So I think I kind of go back to those early days and say that was a great lesson to learn. And it's helped us every year since.
There's something that I don't think people talk about or realize. So from the time that you joined, the market topped again in about 2007, very close to where it was in 2000. And then it wasn't until about 2013 that it broke to a new high, which means that literally we went through 13 years essentially of sideways. Granted, during that sideways, there was a lot of up and down, a tremendous amount of up and down, but it took 13 years to break out again. And so if you were a buy and holder in that period, you were going to go through a bit of a roller coaster.
I'm glad you brought that up, Rocky. I talk about this a lot, and there's this concept of buy and hold, which people talk about it as if it's a fact, as if it's it's one of those things that's indisputable in the industry. I think of it as a half truth. So it's partially true, right? In the 80s and 90s, buy and hold was a great philosophy. If you were a buy and hold investor in the 80s and 90s, you did well. The markets went up and down, but if you held you held the right things, you did well. But that doesn't always happen. That doesn't always happen in the way you expect it. So from 2000 to 2013, as you accurately stated, the market went a lot of places, but it didn't go up. So if you invested in January of 2000 and held on to, I think it was about July of 2013, you would have had a negative return that entire period of time. And I think it was the average return was like negative 0.54% annually. So basically you lost money every single year over that time. But really, obviously the market has gone up since. But people just say, well, yeah, but it still went up. Yeah, but you lost 13 years of time. Compounding only works if you have time. So and that's only one part of it, because if you actually need to pull the money in those 13 years, now you're pulling it and it's worth less. So I think the lesson here is that, buy and hold is a half truth. It can help, but risk management is also important, because if you're 25, you can afford to wait 13 years and not have it compound. If anything, you're probably adding during that period at lower prices. So that can be a good thing. But if you're 50, 60, 70, that's a really bad time to have the markets going down or sideways. And to put a finer point on it, we're one example. Look at Japan. Japan from 1990 until today, if you put your money in, and I think it was January of 1990, you would still be lower 30 years later. You'd still be lower than that date in 1990. Okay, we're getting closer, but we're still not close. It actually went down for, I think, 22 years in a row, something like that. It's only started to come back up in the last few years. So my point is we can't know the future. So we don't know what's going to happen next year or 10 years from now. We don't know. But I can tell you that from my experience, looking at our country and other countries, there's no reason why we couldn't experience what Japan reached. It's certainly possible. And so if you have a buy and hold mentality and you just assume things are going to go up all the time because they always have, I think you're putting yourself in a precarious position.
And that's true. There's been an amazing tailwind since the 1980s. And I remember them because I remember interest rates being 18%. And going from 18% to essentially where they are now, which is almost zero, that is a massive tailwind for the stock market. Back in the 1980s, if you told people to buy stocks, they would have laughed at you. They would have been like, I get 18% in the bank. Why would I buy stocks? And so I think there is always the wisdom of the day, I'll call it. And right now, the wisdom of the day is buy and hold. But as you said, it can change. And then the other factor, and we'll dig into this a little bit more in detail, is inflation. Because even at the end of those 13 years, the cost of living was significantly more in 2013 than it was in 2000. And so we seem to miss that because it's not really shown anywhere. So it's a hidden loss that you don't necessarily see. And that's one of the reasons I can't stand capital gains taxes, because you actually could be paying capital gains on money that's worth less 10 years later. And so they've got to do something with that at some point. But that's kind of what we have to get up against. So one of the things you talked about early on that started this conversation was risk management. How do you manage risk?
Yeah, it's a good question. There's a lot of ways of managing risk. The way that we look at risk management, it's kind of more of an overlay on life, right? I mean, we talk about it from the investing standpoint, but it actually applies to many parts of your life. So I'll give you the basic framework and we can kind of drill down to different sections if you want. But effectively, the process is identify. So you need to identify all of the risks that are out there, no matter how small, right? Identify them all, mitigate as many as possible, and then accept what's left over. So no matter what you do, let's take investing because it's the easiest one to look at. If you're investing, let's say you invest in a treasury or a CD, right? Most people think, oh, those are guaranteed, there's no risk. Well, there is risk, right? There's different kinds of risk. There's the risk of inflation, right? You're making 1% on CD and inflation's 5%. So you're losing 4% a year to inflation. That's a risk. There's the risk of, let's say, forget all these other around the cusp things. Let's talk about flat out risk of losing money. Is it possible you could lose money on a CD or a treasury? Absolutely, it's possible. It's really, really small, but it's possible, right? Most people think, oh, the government, they're going to default on their debt. They're not going to default on their debt for so many reasons. But let's just say, it is possible. I could imagine a scenario where it's possible. It's just really, really small. So I accept that risk. because it's really small. Okay. Now, if you invest in a stock, it's different, right? Your risk is that it's going to go up, it's going to go down. Maybe the company goes bankrupt. Maybe it does really well. Who knows? But the risk is more obvious because people expect those price fluctuations. Now, if you invest in a public company, you have this volatility of price. If I invest in a private company, we don't see that, right? It might get valued once a year. So you're actually looking at the company as a company, right? You're saying, all right, the company's revenues are growing 30% a year. You know, their profits have grown. You know, you look at all these metrics in a private company and say, all right, good. I'm happy with that. I'm happy with where the company's going. But on a public company, it could still be experiencing all those factors, but the price could go down 50% just because the market did. So that's a risk, right? And I think a lot of people have trouble with that because they look at the fundamentals and they see, yeah, but the price is going down. Well, okay. I mean, that's one factor to look at. We look at risk, and I want to make this differentiation because I think it's important, especially after last year. The last year, the market went down 32.5%, somewhere thereabouts. That's the S&P. Most markets went down similar amounts. Now, most times, if you're losing 30, 40, 50, 60%, I would characterize that as a permanent impairment of capital. Because if you look at, as we talked about earlier, the early 2000s, the market went down and didn't come back for 13 years. You've lost time, which I call a permanent impairment of capital, because you've lost 13 years of compounding, right? Now, you look at last year as an example, the market went down 30 some odd percent, but then it popped back the same year and ended up 10 plus percent, which is crazy. That should have fallen into that category of risk, but it actually fell into a category of what I would call volatility. So volatility, what I would characterize normally is, you know, the markets go up 1%, down 1% in any given day, right? It's just, that's what the markets do. And we all come to accept that because we know that any given day, you can't predict what's going to happen with the stock. But if the stock goes bankrupt, that's a permanent impairment of capital. You're not getting that money back, right? Or a host of other things that could happen. But if the market goes down for 10 years, you've lost that time. So that's impairment of capital. Volatility is something that you typically have to accept to some degree. But I think the risk is losing money that you're not going to get back and having to kind of move on to something else because you made a bad decision. So managing risk is really important. We know if you're investing in a bond that the best you can do is that interest rate. And the worst you can do is losing your money, right? You have to accept that going in, right? So you have to accept that this company, that you feel good about this company paying you back. So all of risk management is really about understanding what all of the risks are. And that's a hard part for most people because most people don't know how to manage, don't know how to analyze risk. Is understanding, mitigating, because a lot of them you can mitigate, right? Like you can mitigate the loss of stocks. You know, there's many vehicles you can use to hedge against that. You can insure against your house burning down with fire insurance, right? That's a mitigation technique. There's many different ways that people can do that, but they need to understand how to do that and what they're trying to mitigate against. And then just accept what's left over. At some level, there's going to be risk somewhere in the equation. And if you're willing to accept it, then great. So that's how we look at risk management, Rocky.
Have you found a way to mitigate against market losses with a reasonable cost? Because obviously risk management costs money. If you're going to hedge against something, it costs to do that. Have you found one that's reasonably priced?
It's a good question because the cost, I always like to use this framework. So I like to think of fire insurance, right? Because most people have a home or, you know, they at least have fire insurance on their home. So if you think about your house, for anyone who owns a house, it's most likely your biggest asset. And most likely it's, it's probably even more expensive because you have a mortgage, which means, you know, you only have part of the equity. You don't have all of it. But let's say, for example, you have a home worth $500,000. Okay. Now you've owned this home for a number of years and, everything's been fine for 20 years. And all of a sudden, tomorrow, your house burns down. You lost $500,000 on that's a big loss. And for most people, that's just too much. So we all buy fire insurance in our house, because what happens is the house burns down. The insurance company pays you $500,000, or actually they pay you enough to rebuild the house, but effectively they're giving you your $500,000 back from the house because they're helping you rebuild it to the way it was. So effectively you're getting that insured. What we do with portfolios is very similar. So when we're looking at portfolios, we have to accept that there is a little bit of market risk in there. It's just you can't eliminate that. So there's going to be some. So there's multiple ways that you can I guess not remove the risk, but mitigate it or minimize it. So there's different tools. You can. Some hedge fund managers will do what they call delta neutral hedging, which is they might buy Google and short Microsoft, or they might buy one railroad and short another. I'm just trying to think. There's so few railroads nowadays. But the point is that's one way to do it, right? Because you're carving out market risk and you're taking individual stock risk, but you're removing the overall market component, which right now is a big component. You could do things like using options. We use options a lot because you can basically buy that insurance in your portfolio, but that comes with a cost. As you were mentioning, Rocky, there's a cost to that. And that can be okay. It depends on the cost, depends on what you're trying to accomplish. And there's ways to minimize that cost. But I think it's really dependent upon your strategy. Because here's the way I think about investing. You can invest in, let's use an example. Let's say the S&P 500. Let's say you buy the S&P 500 in your portfolio. So that's what you own. So you have 100% of the upside, 100% of the downside of that index, which is what you're looking for, right? Now, on the upside, you're feeling great. You get all the upside. On the downside, you feel terrible because you're basically, losing all of it. And then in the middle, if the market goes sideways, you're making the same return. So the market goes three places: up, down, or sideways. There's no other choices. That's it. And there are ways that you can remove one of those, or maybe two, but you can't remove all three, right? You can't only get the upside and no downside and no sideways. So you have to kind of pick what your approach is. Because if you're going all in, right, you're just buying the S&P, the upside is the best scenario. Sideways is okay, but not necessarily great. And the downside is obviously bad, right? So you have one good scenario, maybe two, right? Now, there's other approaches that you can use, say like options. You can choose which ones you want to do. So you might choose to take the upside or the downside or even the sideways one. There are different approaches you can take because you might decide, hey, I think like this year, I know most people haven't realized this, but this year the market has been mostly sideways. It's actually, the index is up, but there's a stat there's a lot of stats, but I just saw a good image last week of the NASDAQ, and I think people have probably already seen this, but I'll just kind of describe it. So if you remove the top 5 biggest stocks in the NASDAQ would actually be down 20% for the year. But if you include those stocks, it's actually up about, I think, 15 or 17% for the year. So you have 5 of the biggest stocks are contributing almost 40% return difference in the NASDAQ. And people aren't seeing this because they're just seeing the total index and they're not seeing that most stocks. So if you're picking individual stocks, you're actually not seeing what's going on beneath the surface. So the point being is this year, for the most part, has been sideways for most of the world. And withstanding a few indexes, it's been mostly sideways since April. Now, if you had chose that as an outcome, you could have done really well this year. You could have done extremely well during that period because you would have made money during a time when the market wasn't going anywhere. But you would have had to make that choice. If you chose wrong, then you obviously wouldn't do as well as if you made the right choice. So the point I'm trying to make is there's a cost to everything. you need to determine what the cost is worth. Because if I think the market is going to go up or down, then it might cost me a certain amount of money, let's say 5%, for the ability to not lose past that 5%. So if the market goes down 50%, I'm good. If the market goes up 50%, I'm good. If it goes sideways, maybe not so good. So hopefully that helps kind of describe the hedging or the risk management approach.
It does. I've always found that when I look at the cost of hedging, it seems to outweigh the benefit just because of my conditions. For somebody else, they may have good reasons for it. But when I've always looked at it, I haven't been able to find that sweet spot to make it work for me.
I think you have to look at this with a few different frameworks. The first framework is it's not 100% or zero, right? You can hedge part of it, right? You don't have to hedge 100% of it. You can hedge part of it. You can also look at it as there's also ways to reduce that. Some people buy options, some people use spreads. There's a whole bunch of ways to look at it. And I think the nice thing I like about options is if you have a desired outcome, you could create almost anything you want. If you think the market's going to go up a little bit, then sideways, and then down, you could create a strategy around that. Like that's the beauty of options. Whereas buying stock is you just hope it goes up. And my philosophy is hope is not a strategy. So
it is not. When we started this conversation, you talked about the market conditions of the 90s. What do you think about today's market conditions?
Yeah, I mean, the 90s were a really interesting period because the markets just went straight up and they defied all rational behavior until they didn't, and that got really ugly. I think since 2009, we've had something very similar where the markets have pretty much gone straight up. They've had a few bumps in the road for sure, but they've pretty much gone straight up. And, I'm not going to say we haven't seen anything like that before, but it's very rare to see that, and it never ends well. But we could be in this condition for the next 10 years. And I throw that out there not to suggest that we will, but I think a lot of people have this. I've got this framework I call scenario-based thinking. Now, we as human beings have what I would call outcome-based thinking, right? So you think of like an election, a presidential election, say the last one, right? Who's going to win? Well, everyone's got an opinion, right? Oh, Trump's going to win. Oh, Biden's going to win, right? Everyone's got their opinion. Doesn't matter what your opinion is, but you've got one. And most likely you're judging the outcome of the day after the election based on who you think is going to win. Yet you have no idea who's going to win, right? I mean, you might guess, but no one has any idea. And it's like asking like, I live in New England. What's the weather going to be like tomorrow? Even the weather forecasters have no idea. I've seen weather forecasts where it says it's snowing and it's like 90 degrees out, and it's not 90, but it's like it's really sunny out, and they're saying it's snowing. Like, we cannot tell the future. We as human beings are really bad at telling the future. Yet that's how we're wired. We're wired to assume that we know the outcome of a situation. So what I do is I use a version of this, which is called scenario-based thinking. So rather than trying to predict the future, which is unknowable, I look at different scenarios. So I look at, what if the market goes up? What are we going to do? What if the market goes down? What are we going to do? What if the market goes sideways? What are we going to do? So then no matter what happens, I'm prepared for it, right? It doesn't mean that we're never going to lose money, because anyone tells you that's a liar. But what I'm telling you is that no matter what happens, we're prepared for it so that we have a way to handle it. So for instance, last year, the markets are down 30 some odd percent. We were down maybe like 3.5 for most clients. Not because we knew COVID was going to happen, but because we were prepared for something to happen at a given time. So we were okay with that. So in the moment, and I found this to be true in 2008, where a lot of people were shell shocked. They didn't want to make any changes because, I lost a lot of money. I'm going to wait till it comes back. But that's a really bad way to handle it. I mean, think about it. You've already lost the money. So what's the best thing you can do? Well, you find the best stocks at the cheapest prices and you buy those, because obviously what you did didn't work. So you come up with a strategy that works and takes advantage of this new situation. Because there's always opportunities in the pit of despair. Even last year, we saw tons of opportunities. that you normally never would have seen. I mean, oil futures are negative $30. I mean, that's crazy. How's that possible? But it was. So I think in looking at today, circling back to your question, compared to where it was then in the 90s, it's very similar. And we're prepared for a bad outcome, but we're also prepared for the markets to keep going up higher from where they are. I think it's unreasonable, but the markets typically defy reason. They call it climbing the wall of worry. Is a very frequent phrase which is used where people are really concerned. The market will continue to go higher. It's the framework I would think about the markets is this. It does a really good job of doing everything to frustrate the maximum amount of people. So if everyone thinks it's going up, most likely to go down or sideways. If everyone thinks it's going down, it's probably going up. So that's how the market, if you use that framework for thinking about the markets, you'll probably have more success, even though it's completely irrational. You'll probably have more success than not, because that's typically how the markets operate.
And it's the emotional roller coaster I have learned to tame.
Mm-hmm.
Of dealing with it, because I've been through I've been through 2000, 2008, and what happened in 2020, and it's a constant battle. And I also realize that I'm always wrong in what I think is going to happen. So sometimes I say to myself, whatever I think, I should just bet the opposite, and I'll probably do really, really well, which is kind of what you were saying.
Yeah, I think it's not necessarily the opposite. It's just understanding our own failings. And I'll give you this one kind of other framework, is that you need to understand your own investor psychology. You need to understand where you're strong and where you're weak. I've been doing this for, God, how long have I been doing this? Like close to 25 years now. And I know I have certain weaknesses. Like, for example, like stop losses. I use stop losses. Problem is, if you put them in the market, they get triggered because people see them and then they sell and then it goes back up. So you can't put them in the market, which means you have to keep them in your head. But if you do that, now you're basing your psychology on whether you're going to do that or not. Like it hits your stop loss and you're like, I think it's going to bounce from here. It's going to go higher. Maybe I'll give it a little more room. You kind of rationalize with yourself, at least I do. So I've come up with other systems to handle that, because that system doesn't work for me. So there are certain things that I'm not good at, and I know that about myself, so I don't use those. Other people are really good at those, so they use other systems. But it's not important what my system or your system is. It's finding one that works for you individually. Takes that, it really requires time and effort on your part to just be mindful of how you react to things. Because Warren Buffett, a lot of people try to mimic Warren Buffett and very few do, because he has a certain way of investing that works for him. Whereas most people can't do that because it requires too little effort. They feel like they need to do more, or it's not moving fast enough, or whatever the thing is. They need the action. So people just need to understand that about themselves. So find a system that works for you.
And that means you need to understand you. And that takes time and insights and a little bit of life. Today's episode is sponsored by Profit Answer Man Podcast. Did you know that most small business owners hate looking at their financials? It's one reason they may struggle with business success. The Profit Answer Man podcast helps them ensure they are profitable and can pay their employees and weather the storms we all have to face. It's built on the Profit First methodology of pay yourself first. The Profit Answer Man podcast is a must listen to for every small business owner and anyone who wants to help them survive and thrive. Check it out on your favorite listening platform. So one of the things that's come back now that I don't think most people understand, and having grown up in the 80s, I do, and that's inflation. Any advice for how people should think about inflation? Because we don't know what's going to happen, right? Some people are saying it's temporary. Some people are saying it's going to be long term. We don't know that yet. What can we do in the meantime to at least be aware or maybe prepare for a change in the way inflation is coming?
Yeah, and even though I just kind of said that we don't know the future, I'm going to try to predict it here because I think there's something that is a part of inflation. Because, like you said, you have some experience with that, and most people haven't seen it in decades. So I think there's this thinking that is money printing equals inflation, and people have been thinking that for a while, and it's not necessarily accurate. It's what we would call a half truth. Because technically, if you're living in a vacuum, sure, that can work. The problem is that's not necessarily an accurate statement. So if you thought money printing equals inflation, then why didn't we have inflation from 2009 until pretty much 2019? We had 10 years where we had very low to almost no, and I would argue in some cases negative inflation, even though it wasn't reported that way. But I would argue that was very low inflation at best. And people thought printing all that money would lead to high or hyperinflation, yet that didn't happen. So the fact that we printed a lot of money last year, I don't think led to inflation. I think the inflation is largely based around the supply chain problems that we have. And if you use that as an understanding, then you're not going to get duped into money printing equals inflation, because that is something that causes people to make bad decisions. So the supply chain problem is a problem, and I think it's going to take a while to get worked out, which means we'll probably have inflation for a little bit of time. I have a lot of clients in different industries, and one of them said at the very earliest, we're looking at pretty much 18 months before this gets cleared up for us, and maybe even longer. So depending on your industry, and depending on the leadership in this country, which, not to characterize politics, but I think all of the politicians lack leadership. So we don't have anyone kind of leading that charge to fix the systemic problems. So hopefully people in the private sector can do that. So that being said, I think it's going to be here for a while in some shape or form. So I think the way to handle it, if you look back in the 70s, we had a bout of inflation. It was really difficult. And people need to understand the different types of inflation. There's a supply side, inflation. There's, actually inflation, let me just take a step back. Inflation is actually a descriptor. So it's not a noun, it's an adjective. So people think of inflation as this thing. In actuality, inflation is a descriptor. So it could be wage inflation, commodity price inflation, monetary inflation. It describes something. And I think most people just look at it as a number. So if you think about inflation as an adjective, I'll give you an example. We've had wage stagnation for the last 20 years. Now, depending on when you're looking at it, could be up or down. I think right now it's going up, but more or less for 20 years it's been stagnant. Commodity prices have been deflationary for the last 20 years up until recently, which has stymied a lot of people. You've had the price of technology has been deflationary for pretty much the last 20 years, but you've got the cost of healthcare, the cost of college is highly inflationary year in, year out. You've got goods and services, which depending on the industry could be good or bad. I mean, last year, travel and leisure was deflationary, whereas, books at home and movies and subscription service were inflationary. So depending on what you're looking at, that can go up or down. But in the broader context of inflation, the way I would look at it is there are certain things that will hold up and there are certain things that won't. So things like bonds will do very poorly. We have close to 0% interest rates. Let's call it 1% to be kind, but for most bonds, let's say it's 1%, unless you go really far out in the curve. And inflation is 5%. So you're basically losing 4% a year to inflation. So bonds are not a great place to be. However, it's a great place to be if you're on the other side of that. So if you're taking out a mortgage, right, you're basically giving somebody else a bond. And so they're losing value over time, and your bond, your mortgage is the price of your mortgage is being devalued over time, which means you're making money on that. So if your mortgage is say 3% and the inflation is 5%, then the value of your mortgage is going down 2% a year plus whatever you're paying it off. So it's kind of like a hidden deflationary pressure for your mortgage. So it makes a lot of sense to take out debt. Now, I'm not suggesting everybody go take out debt because I think in many ways that's a bad thing. But if you're doing it for strategic purposes, it can make sense. Getting a mortgage on your home makes sense because almost everybody has a mortgage on their home. So that's why a lot of people are buying real estate right now, because no matter what, their mortgage is going down in price and inflation should cause real estate to go up. So real estate is a good marker for inflation.
Hang on a second on that one, because this is one that I remember from the late 70s into the early 80s. And I think it's even more true today.
Mm-hmm.
People don't buy houses, they buy payments.
Mm-hmm.
And if we have inflation and mortgage rates go from the lows that they are now up 2 or 3%, I would assume that the house price has to come down because people can no longer afford the payment.
Yeah, so that's a great point. I've talked to a lot of real estate investors, professionals, institutional investors about this very question. So really, as you accurately point out, so back in the 60s, I guess you could say, people were buying the asset. And I think it was right around the 80s. I don't know when this actually started, but I think it was around the 80s, where people used leverage. They started using mortgages. So all of a sudden you can afford more. Because instead of needing to save $50,000, now you only need to save $10,000 and you could put the rest on payments. So it allowed real estate prices to go up a lot. But now with real estate prices high as they are, people are squeezing themselves on the payments. And so what ends up happening is interest rates should dictate the price of real estate. So as interest rates right now, let's call them 3%, right? So mortgage rates, let's call them 3%. If you have a 3% mortgage, you can afford, I don't know what that is. Let's say you can afford, that's $1,000 a month on a $400,000 home, okay? So you can afford $1,000 a month. Now, if that rate goes from 3 to 4%, now you can only afford $350,000 home, right? So it's the affordability of it is what you're referring to. And because people are squeezed, the affordability is based on their payments, not on anything else. So basically it allows interest rates to squeeze the affordability. Now, I don't see interest rates going up a lot. I know people talk about it. I don't see that happening for a while because they can't afford to. It would implode the entire system if they decide to raise rates too high. I think we might have about 1% in there that they might be able to go up, but beyond that, I think they're going to implode the system, and they know it. They're not dummies. So I think your point is valid, but the challenge is, what if interest rates don't go up? Then what happens? What if they just remain flat? I mean, look at Japan. Theirs have been flat for decades. So what if we enter that? Then what happens? What if we have negative rates? I mean, Japan's been negative. What if we have a negative mortgage? How many mortgages are you going to take out if they're negative interest rates? Probably as many as they'll give me, right? Right? So, I mean, that's how you have to think about it. It's a complex problem. It's not necessarily simple, but you're hitting the nail on the head. Inflation is a real problem. I mean, people talk about gold and inflation and cryptocurrencies. I think that's fine, but I think it's more complex than that. I think that's the part that you will start to see more and more as things evolve, but I think there's a lot of complexity in there that people need to accept that is a part of the problem.
And I agree with you. And I think, so this creates unintended consequences is, I guess, how I label it. The Fed is going to keep interest rates down because, as you said, they can't afford it. But inflation still runs high, and that essentially causes repression. So while you think you've got more money because it looks like it, your money is actually worth less. And so you have less. And I think that works until it doesn't. And don't ask me to pick a date, right? Because I have no idea when it is. But when I look back at every single crash in the stock market, I think going back hundreds of years, it seems like the underlying cause was always the Fed getting it wrong. And it wouldn't surprise me if that happened again. not an idea of when. Like you said, it could be tomorrow. It could be 10 years or 20 years from now. So in the meantime, you still have to figure out what you're doing to go forward.
Well, I think there's an interesting overlay here because you mentioned the Fed got it wrong. What I think is interesting is let's look at the global economy, because things used to be disconnected. Now they're more connected. But let's look at the last 20 years. You have three very distinctly different outcomes. You have the US, you've got Europe, and you have Japan, right? So Japan went into a recession and really never came out. Like they had deflation and they got it wrong. They have not gotten out of deflation. And people know that. They use them as an example of what not to do. It wasn't a terrible outcome, but it was definitely a problematic outcome. And I think if we had the culture they had, it would have been a huge problem. I'm sorry, if we were in their situation with our culture, it would have been a problem. Their culture allowed them to get over this because they've collectively accepted deflation. So for an example, the Japanese culture, they're very much into the community, into the country. So as a group, as a company, let's say a company, right? So let's say you have deflation of 5%. Well, you would naturally assume that wages should go down 5%. So in the US, we just lay people off. That's how they get rid of that 5%. In Japan, they said, no, we don't want to lay people off. We'll collectively accept 5% less in wages so we keep people employed, which I think is a very admirable outcome, but it takes a different kind of culture to be able to accept that. Not everybody will accept that. So deflation is challenging, and they've handled it reasonably well, but they're struggling to come out of it. So they're one example, right? Their markets went down, interest rates went down. They haven't been able to get out of it really easily. Now, if you look at Europe, Europe has taken a more stagnant approach. So instead of going down, theirs is more stagnation. Some ups, some downs, but basically sideways for the most part the last 20 years. And then you look at the US, which has had a huge amount of volatility. If you just look at a decade, multi-decade long chart, huge volatility from January 2000 to the low, of 2003 up to 2007, down to 2009, huge swings in the market. So even though we've effectively still gone higher, like we're much higher than we were at those other highs, but we've handled it differently. We've accepted bigger swings and bigger risk movements. Whereas some of these other places just said, no, we don't really want that. We just want things we want to keep things a little bit more in the middle. So we've accepted more volatility because we're basically less resilient. So we're more of a fragile economy. And so because of that fragility, we want less risk, but actually we're taking more risk. So how we've handled it and how other places have handled it are important to understand, because you need to think about what is the potential outcome here. Because if we do have high inflation here and we keep interest rates low, at some point they will have to raise rates to knock it down. But I would also point out one last thing. I feel like I rant too much here. Is the velocity of money is something nobody really ever talks about. And that is one of the biggest determining factors of inflation in this country. If you look at the velocity of money for the last 20, 30 years, you'll notice something really interesting. It's gone down for, I think, the last 15, 20 years. It just keeps going down. So it allows the Federal Reserve to print more money, and it doesn't have any greater impact on the economy. What you want to watch for is if that really starts to pick up, then we're in trouble, because that's really when you start getting high inflation, is when the velocity of money picks up, and that's when hyperinflation is a problem. But until you start to see that, I think we're generally able to accept kind of the status quo of where things are. But that financial repression that you talk about is an immense problem that people won't realize for probably 5 years, and they'll wake up and say, wow, what happened? So that's a huge problem. And that's why they were able to get away with it, because they don't advertise this is going to happen.
No, they don't. And it looks like you have more money because the actual number has gone up, but the part that you can't see, which is the value side, has kind of gone down. And all you have to do is think about it is just look at prices from 20, 30, 40 years ago and compare them to prices today, and you will be shocked. at what has happened. But as you said earlier, certain prices have come down. So the cost of technology continues to go down, but other costs have skyrocketed. And overall, I think the cost of life has somewhat gone up, especially with the big things, which are your house, your car, energy, and healthcare, right? Those are all been major, major drivers to the upside, including education if you have kids. So yet to be seen what shall happen going forward. So you have a podcast called The Money Tree, where you are constantly talking about money. Any lessons learned, ahas from your podcast?
Yeah, I think so Money Tree Investing was really kind of an outgrowth of my desire to talk to many different smart people and really just get different opinions. Because I think, there are a lot of different opinions out there, but our goal is to really derive some different angles. So we'd interview a guest and then we'd have a panel after where we have a few different perspectives. And we don't always agree, and that's the point, is to help give people a well-rounded view on different topics. So I've been able to interview people that I've idolized in the past, and I've been able to pick their brain and get some idea of how they think about things. And I figure if I'm going to call these people, because we have conversations all the time with, investors and portfolio managers, like, why am I the only one who's able to benefit from this? Why don't I just share this with my listeners so they can also learn from things that I'm trying to learn? And hopefully the lack of education in schools, like hopefully people can learn from this so they themselves can become better investors.
And that's kind of the same reason I did the podcast is as I'm learning, I'm sharing what I'm learning too. And it's a great way to do that. And when you can find these opportunities and give back as well, it is always very, very good and a lot of fun.
Yeah, I mean, it's a great service that you provide here as well, Rocky, because this is, it does take time. It's a lot of work, but, I think it's important that people like yourself are out there, providing this service because people need to understand it. And most people don't know where to even go to find this information, right? I mean, it's not like the media is giving you the straight scoop, right? You're always getting a half truth from them as well.
Well, and I think that's the problem. In the world of money, there is so much hype and so much bad information. And I think a lot of it, and I've seen it just in conversations with people, because most people have not been taught about money and don't understand money, even the so-called experts, you can tell if you start to really listen and question that they don't even know what they're talking about. They're kind of repeating what they've been told. But when you question them on it and how it comes to be, they don't understand the principles behind what they're saying.
Yeah, I can actually give you a great example for that. So Roth IRAs, everyone loves the Roth IRAs because you can put your money in and it grows tax-free. Everyone loves that. And I feel like no matter who you are, it's just, they just want to get as much money into the Roth IRA. And if you understand the math behind it, if you actually take some time and do the math behind it, you realize it's not really as special as people think. And I'll give you an example. If you take two people, let's say you and me, right? We both put in, we both have $5,000. You're going to put money into a Roth. I'm going to put money into a traditional IRA. So I can put in the full $5,000 because it's pre-tax. You can put in, let's say, I don't know, $4,000 for an example, right? Because you have to pay tax on that $5,000 as income. And then you can put in $4,000 of that. Well, you might think, well, hey, Rocky, you're in a rough spot because you have less to start with, so I'm going to win. Well, if you do the math, at some point I have to pay taxes and you don't. So what's really funny is the numbers actually come out identical, all else being equal. So no matter which one you have, the outcome is the same. If the investment returns are the same, you're going to have, and you take it out the same, everything being the same, you're going to come out with the same outcome. But people think the Roth is better. there are hedge fund managers that you probably know the names of that are really, really bright people. They don't even know this simple concept because no one talks about it. It's just assumed, like you were talking about, there's this assumption that, oh, a Roth is better, but it's not necessarily better. It can be.
So it has to do with the differentials in tax rate currently and in the future, and what your tax rate is currently and in the future. I think the Roth still wins out. And the reason I say that is, let's just say you're making $200,000 today. That $200,000 to the $195 for the $5,000, it's probably being taxed at your highest tax rate that you're at. So I don't know what the exact bracket is. Maybe it's 28%. When it comes to retirement, if you no longer have income, and now I've got, let's just say, $1 million in either of these situations, and I pull $100,000 out, my Roth is not going to get taxed. So I'm going to get my full $100,000. But my other account, when I pull the $100,000 out, and people don't even understand this graduated tax system. When I pull the $100,000 out, the first 10 or 15,000, and actually, if you're married and you get the standard deduction right now, the first 24,000 you pay no tax on. The next X amount you pay maybe 10 or 15% on. Then, when you're up to 35,000, now you're paying 18 or 20% on. And then when you get up to the final, whatever, 40, 50,000, you're paying a higher rate. And so that graduated rate is really where the differential comes in. And I know some people who are really nutsy, and what they will do is stop working at 55, and they'll slowly convert these things while they have zero income. And so they'll figure out how to never pay tax, even on the taxable portions. It's a game to play, but you've got to live within the parameters of the game. And you have to be willing to change your lifestyle, which not everyone is willing to do. And you have to be willing to figure out the math. So the one thing I've learned now is when it comes to talking money, it depends.
Yes. There's a lot of factors that go into it. And I think the lesson here is half truths. And I'll make a point here. Think of an industry, any industry, profit, nonprofit in the world, that doesn't have all these half-truths baked into it now. It didn't used to be that way. There used to be some, but I feel like I can't think of one industry that is not filtered with half-truths, that you only hear half of it. And I'm not saying it's deceptive or anything. It's just how it's all built, right? The medical industry, these doctors are smart people. They don't know all the truth. Like there's degrees of this. Like you said, it's like, is this true? Well, sort of. It can be true. It depends on who you are. I feel like that's such a problem today, that there is no finite truth, that it leaves everyone to just struggle and try to tread water.
And I agree with you that. And in the medical, I spent my life in the medical side, and there are so many half-truths. We're not even going to go there. Based on our conversation today, what's one action step people can take to move forward this week?
That's a big open-ended question there, Rocky. I would say, and I think, this is something that people should always do. I spend a lot of time trying to understand mindsets, is how to improve my own mindset. I mean, I know we're talking about investing today, but really to be a successful investor, it comes down to having the right mindset. And a lot of that comes down to is understanding yourself, is having this ability to self-assess yourself honestly. We all have an ego. We all think we're better than we are in many aspects of our life. And it's just truth. It's just, we have to, right? We have confidence in ourselves. We appreciate certain parts of ourselves. But I always kind of look at it as I'm always pretty ruthless about looking at myself. Where can I improve? I might be really good in this area. How can I be better? And sometimes I struggle. I say, wow, I just made a lot of improvement in that one area. And I feel like, I couldn't possibly get better. But then I keep digging and find out, I can definitely be better in this area. So I think, especially with investing is a psychological game. And the reason that people use computers is because they don't trust themselves. We all have weaknesses psychologically. And no matter how smart you are, actually, in many cases, the smarter you are, the more easily you are duped. That is actually a scientific fact, that the smart people get duped easier because they think they know the answers. And it's more of kind of like it's almost like a stoic kind of attitude, right? You have to be willing to look at things, with an unbiased lens and say, all right, what needs to be done here? Because if you're not improving every day, if you don't understand yourself well, then you get yourself into trouble. And especially now where the markets have gone up so much. And I mean, think about it, Rocky. You and I have been around for a while. There's a whole generation of people that haven't seen a real problem. They haven't seen a recession or depression or a bear market. Like last year wasn't a bear market. That was a bump, right? But seeing like a 2008, seeing like an early 2000s event, anyone who's been in the markets the last 13 years and that no further, they haven't seen that. They have no idea how to handle that situation or what it looks like or how people feel. I've ridden through that with people. I know how people are going to act in 2000 when that happens again. People are going to get shell shocked. They're not going to react. They're going to go into a hole and they're not going to take advantage of huge opportunities that are available to them. So my point is you really need to think about where your head is. And, just because people say don't confuse brains with a bull market, right? Like a lot of people think they're really smart, right? Oh, I invested in crypto. I'm really bright. Okay, great. Good for you. Let's see what happens when it goes down 70% like it did this year. Like all of a sudden people get scared. Like, okay, yeah. maybe I should lower my position sizing on that,
I always say the reflection in the mirror is what you've truly got to conquer.
Yep.
It's time to learn the secrets of life. What's your secret to living an abundant life?
That's a great one. Secret to abundant life, I would say it's really a mindset thing. I mean, I spent a good part of my early adult professional life in a scarcity mindset. And I think it's just understanding that that the world is abundant and that the more you look at the world in an abundant lens, the more it will give back to you. I don't know that there's an easy way to describe it. It's just something you have to find for yourself. And once you do, it's going to be obvious, but finding it is tough.
I think we've walked the same journey. I get it now.
Yeah, I get it now. I didn't then.
Which leads to our next question. What did you learn later in life that you wish you would have learned sooner?
Yeah, I think it's hard for me to answer that question because I think that a lot of people look at their life with regret and say, I wish I didn't do that. I look at it the other way. I say the only mistakes you make are the ones you don't learn from. Because I've made a ton of mistakes in my life and I hope I've learned from them all, but I know the big mistakes I definitely have. And because of that, it's made me who I am. So I never regret the things I learned. I think all of us learn. We always would like to learn from other people better so that we don't have to make them ourselves. But I think learning from it and overcoming the challenge, it gives us stories that we can use to teach others. I've got a lot of stories, Rocky, as I know you do, because I've made those mistakes. But if I didn't have those stories, how do I teach somebody else without a story? So that'd be my answer.
And so my response and my answer to that is, I wish I had learned to listen to more stories.
Yeah, good.
Instead of having to create my own. If you were to give an 18-year-old one specific piece of wisdom, what would it be?
Well, I've got two young boys, so I'm trying to distill that down as much as possible. I would say, I'll maybe rephrase it. I would say kind of like, I think of like, what is greatness? And my answer is, it's being the best person you can be for the benefit of others. And so I know it's hard to grasp the concepts that we talked about here, some of the concepts today, like mindfulness for young people. because I think at a young age, you don't know what you don't know. You think you're smarter than you are. And everyone goes through this. I know I did. And I think there's this journey of self-discovery that people need to accept. So they need to have an agile mindset to always be adapting, always to be improving yourself. Because I think if you don't look at life as a journey of constant improvement, then you get static and you get this fixed mindset. And that's where you get into scarcity thinking. Because once you stop growing, then you feel like there's scarcity and it doesn't help you evolve. So I think that getting the right mindset, having that kind of growth mindset is really important.
The two classes they never have in school, money and mindset.
I know, the two most important things.
Well, if people would like to learn more about you, listen to your podcast and follow your work, what is the best way for them to find you?
Sure. Thanks, Rocky. Yeah. So the best place to find me, I'm really not hard to find. You can go to moneytreepodcast.com, and we have a show every week with personal finance and investing. And you can also find me at innovativewealth.com. So that's our wealth management firm. I've written all the blog posts there. We talk about a lot of these concepts and these ideas. So, if you're interested in learning more, you can find me there, or, I'm on the social medias as well. So, like I said, just not hard to find.
And we'll put them all in the show notes. Thank you so much for joining us today.
Yeah, thanks for having me, Rocky.
We live in interesting times, and having been through multiple market cycles and watching my behavior, I know what I'm like. Now I have to make sure I can overcome myself so that I can ride the waves. Have you examined how you behave around money? How do you invest? And does it match your natural tendencies and behaviors? That's this week's action step. Understand yourself and your mindsets and how they relate to your life and investing. Ego's a big part of this. And I know I have made so many mistakes in investing because of my ego. I am now better about realizing when I'm being stupid because I think I'm being smart. We're back where we started today. Who are you and what are your special gifts that are unique to you? Are you using them or are you fighting yourself? Next week, we're going to dig into this further. We've got Jonathan Dio on to talk about mindful money and the 8 pillars of happiness. Hey, if you enjoyed this, would you mind sharing it? I would appreciate that. Thanks for listening. Have an abundant week.